how do private money lenders secure their position in a real estate transaction that they fund? In this video, I'm going to explain how that's done. It's a very simple process, but there are a number of steps to the process, and I'm going to explain what those steps are and how you, if you become a private money lender, you want to follow some of these steps, and you'll want to also consult with a trusted advisor, particularly an attorney who will draw up the documents for the security deed. And this is how you secure your position in a real estate transaction. So if I have a transaction that I need $300,000 to purchase and renovate a single family house, and I have $100,000 that I can put down, and I need $200,000, and you are willing to loan me $200,000 to purchase the property and to fix it up into a like-new condition so that I can resell it for a profit. Maybe the house is worth $375,000 or $400,000 after it's all fixed up. So you're loaning maybe 50 cents on the dollar of the value of that property by loaning $200,000 in a property that will be worth $400,000 as that capital is used to increase the value of the property. So that's one way that you secure your money, that you put your money as a private money lender into a deal that has equity in it. You don't want to loan $400,000 on a property that will be worth $400,000 when it's renovated. It doesn't make sense. So you want to have a equity in the property, and you don't want to give a loan, 100% loan for what the property's worth. Otherwise, your position's not secured. If the market were to go down, the house would be upside down. More money would be owed on the mortgage than is the value of the property. And you don't want to get into that situation as a private money lender. So most of these situations, an investor will have some money, or he'll find a deal that just has a lot of equity in it, so that when you give your loan, your position's secure, because compared to the value of the property, you're loaning maybe 60% of the value, or 70%. Whatever it is, whatever your comfort and risk profile is, and the investor can might have some guidelines, and you can look into this, but you want to make sure that you're not over lending. The other way to secure your position really is to get a security deed written up. This is just like the mortgage paperwork that a bank would use when they loan money to a home buyer. The attorney will write up paperwork with you as the lender, as the bank. You're basically taking the position that a bank normally would, and the attorney's writing up the paperwork with you as the bank, and you're loaning money to the investor, and the investor has to pay you back according to the terms that are outlined in the security deed. And this might be monthly payments, monthly interest payments, and the length of the term, and when the final payment is due. So if this is a 6-month loan, the investor may have to pay you interest every month, and then at the end of 6 months, they have to pay back the principal and pay off the loan. And if the investor in this scenario does not perform according to the agreed upon terms that are written up in the security deed, you as a private money lender can foreclose on that property, just like a bank would foreclose on a home buyer that's not paying their mortgage. And in that worst case scenario, you don't want that to happen as a private money lender, but this is how your position is secured in this worst case scenario. You can foreclose on the property. Maybe you've loaned $200,000 and the property is now worth almost $400,000. And you can sell that property and get your $200,000 back. It's not your responsibility that the investor get made whole, but it's the investor's responsibility, and he signed over the right to you to foreclose on the property so that you get made whole again. So this is how you secure it. It's done with an attorney. Different states have different laws. In Georgia, it's an attorney state. Attorney do real estate closings. In many states, it's a title company. But in any case, there's a deed of trust or a security deed that's written up, filed at the courthouse, and it protects your position with the money that you put into the deal as a private money lender. So this is how you collateralize your loan. the house, the property, the real estate as the collateral and gives you a secure position with rights to foreclose. So if you have any questions about this, feel free to call me or text me. I'd be glad to talk to you about this and how this works. And there are different ways of structuring this, but always your position as a private money lender is secured with a deed of trust or a security deed filed at the courthouse, with you having the right to foreclose on the property and take ownership of the property if the investor does not perform.